Welcome to the deep dive. We take complex information, stacks of it sometimes, and boil it down to what really matters for you. Today, we're plunging into the latest financials from, well, a global tech powerhouse, Alibaba Group, a company whose moves really do affect how we shop, how businesses run, everything. We've got the official results for their quarter ending June 30, 2025. And this isn't just a numbers game. It's about looking under the hood, seeing the big strategic shifts they're making in areas like AI and e-commerce. Our mission today, to really unpack what's driving this giant, where they're placing their bets, and what that might mean for, well, all of us.
Absolutely. And what's really interesting here, I think, is going beyond just the headlines. You look at a company like Alibaba operating at such a massive scale, their decisions, their financial results, they tell a story. It's about market trends, future investments. It's a strategic narrative. And hopefully we can help connect those dots for you.
Okay, let's dive in then, starting with the top line numbers. The revenue. Alibaba Group reported total revenue of RMB 247,652 million. That's what, about US $34.57 billion. Now, on the surface, that's a 2% increase year over year. Seems kind of modest.
It does seem modest, yeah. But there's a really important detail in there. If you actually strip out the revenue from businesses they've sold off, like SunArt and InTime, their like-for-like revenue growth was 10%.
Ah, okay, so that like-for-like number is pretty key then.
Oh, absolutely crucial. It tells you how the core ongoing businesses are really doing without the noise from those disposals, so
No.
10% growth. That suggests much stronger underlying momentum in the parts of the business they're actually focusing on.
Right, okay, that makes sense. So the core is growing nicely despite those strategic sales. What about profitability then? Income from operations that dipped slightly, down 3% year over year, to around US $4.88 billion. And adjusted EBITDA, that measure that gives a cleaner look at operating performance, that was down 14%. So what's going on there?
Well, that dip, it's directly linked to what the CFO, Toby Zhu's, highlighted. It's about investment. Big, significant investments. They mentioned pouring resources into this new thing called Taobao Instant Commerce, plus, broader spending on user experience, getting new users, technology, the usual suspects for growth plays.
So they're spending money now for future gain, essentially, sacrificing some immediate profit.
Exactly. It's a very deliberate choice.
But hang on, here's a curveball. Net income attributable to ordinary shareholders, the bottom line, it surged, up 78% year over year to US $6.01 billion. How does that square with the lower operating profit? That seems like a huge jump.
It is a huge jump,
Yeah.
and it highlights that critical difference between operating performance and the overall financial result, that big surge. It was mostly driven by things like mark-to-market changes from equity investments, basically paper gains on investments they hold, and also a gain from selling part of Trendyol's local business.
So not really cash from their main day-to-day business.
Precisely. These are more like one-off or non-operating items. If you look at their non-GAAP net income, which strips that stuff out, that actually decreased by 18% year over year.
Ah, okay. That aligns more with the adjusted EBITDA drop then.
Exactly. So understanding that distinction is really vital to see the true health of the core operations versus these other financial movements.
Got it. So strategic investments hitting operating profit, but some non-operating gains boosting the final net income figure. Now, as the CEO, Eddie Wu, he keeps talking about two main strategic pillars: consumption and AI plus cloud. Seems like that's where the focus is. Let's look at consumption first. What's happening inside their main China e-commerce group? Well, they launched this Taobao Instant Commerce service end of April, on-demand delivery for, well, pretty much anything. And it looks like it's catching on. Monthly active users on the Taobao app jumped 25% year over year in early August, and quick commerce revenue itself was up 12%. That seems pretty significant.
It is significant. And it's fascinating how they're using their existing huge platform, Taobao, to push into this super competitive quick commerce space. It's clearly a land grab, right? Trying to win what they call consumer mindshare and build business scale.
But there's a cost.
Oh, definitely. The trade-off is right there in the numbers. That investment directly hit the China e-commerce group's profitability adjusted EBITDA down 21%. It's that classic dilemma. Growth now versus profits now. They're clearly choosing growth in this area.
And are they keeping their best customers happy through all this? They mentioned the 6.18 shopping festival was a success, and their top spenders, the 88 VIP members, kept growing by double digits. Over 53 million now.
Yeah, that's important too. It shows they're managing to retain those high-value customers even while they're making these big, potentially disruptive bets elsewhere. Loyalty matters.
Okay, let's pivot to that other big pillar. AI plus cloud, the Cloud Intelligence Group. Revenue there soared 26% year over year. That's huge. US $4.66 billion. And this really jumped out at me. AI-related product revenue, triple-digit year-over-year growth for the eighth straight quarter. 8 quarters.
Incredible, isn't it? That sustained triple-digit growth.
Mm-hmm.
It's just phenomenal. It tells you not just about the massive demand for AI, but also about Alibaba Cloud's position. An Omdia report called them provider of critical infrastructure for the Gen AI market, things like their Model Studio and PAI platform.
PAI being platform for AI.
That's right. These tools are basically helping companies build their own AI applications.
Yeah.
So Alibaba isn't just selling computing power, they're selling the tools to actually use that power for AI.
Yeah.
It's clearly a massive and rapidly growing revenue stream for them, not just hype.
Makes sense. They're enabling the AI boom. So moving beyond China and the cloud, how are their global plans looking? The Alibaba International Digital Commerce Group, ADC, revenue there grew 19% year over year, about US $4.85 billion, mostly from cross-border stuff, still a solid growth engine.
Yeah, solid growth. But what's maybe even more interesting with ADC is the efficiency story. They mentioned they significantly narrowed losses both year over year and quarter over quarter. They almost hit break even. Adjusted EBITDA loss was just US $8 million. That's a 98% improvement from last year.
Wow, 98% improvement. So they're getting much better at making money internationally, not just growing sales.
Exactly. It shows a real focus on operating efficiency. They mentioned improving unit economics for things like AliExpress Choice and Trendyol's international side. Seems like they're really tightening the ship, moving towards more sustainable, profitable growth abroad, less growth at all costs.
And they're using tech to help there too, right? Mentioned engaging local merchants using AI tools for wholesale.
Yeah, integrating tech deeper into the global strategy. Makes sense for finding efficiencies and competitive advantages.
Okay, so strong growth in cloud and international, efficiency gains abroad, but heavy investment impacting profits in China e-commerce. Let's talk about the actual cash. Net cash from operating activities was down quite a bit, 39% year over year, landing at about US $2.88 billion.
Yeah, and that directly reflects what we've been talking about, those big strategic investments. When you're spending heavily on new ventures, infrastructure, user acquisition, it eats into the cash your operations generate in the short term. It's the cost of that investment strategy.
Right, and that leads into the free cash flow figure, which was maybe the most dramatic shift. It went from an inflow of over RMB 17 billion last year to an outflow of almost RMB 19 billion this quarter, about negative US $2.6 billion. That's a huge swing.
A massive swing. And it's the clearest signal yet of their capital allocation priorities right now. The report directly links it to that increased spending on cloud infrastructure supporting all that AI growth we talked about, and the big push into Taobao instant commerce.
So they're actively using cash to build for the future.
Exactly. They still have a huge pile of cash and investments over US $81 billion. But they're not just sitting on it. They're deploying it aggressively for growth and innovation. It's a deliberate choice. Fund the future, even if it means negative free cash flow for a period. They're spending big to win big, basically.
But even with all that spending, they're still returning cash to shareholders. They bought back about US $815 million worth of shares during the quarter, and they still have, US $19.3 billion left on their current buyback program through early 2027.
Yeah, and that's an important signal too. Doing share buybacks amid such heavy investment shows confidence. It tells shareholders, look, we believe in our long-term value, even as we make these bold bets. It's a balancing act. Invest aggressively, but also keep current shareholders in mind.
Okay, so let's try and pull this all together for you. What's the big picture from Alibaba's June quarter? It really looks like a company doubling down, reinvesting heavily in its perceived strengths. Consumption, especially quick commerce, and definitely AI in the cloud. Now, that comes with short-term hits to operating profit and, quite dramatically, to free cash flow, spending money to hopefully make more later. But you see the underlying revenue growth in those key areas strong, and the overall net income got that big boost from non-operating items. It's
dynamic. It really is dynamic, and it clearly shows that balancing act global tech giants have to perform. How do you invest aggressively enough to capture these huge future opportunities like AI without completely sacrificing current profitability? It's a high-stakes game of strategic choices, and these results show Alibaba making some very bold ones.
And for you, listening, understanding these moves isn't just about tracking one company. It's really about seeing the leading indicators, right? Where is the global economy shifting? Where is technology taking us next? Alibaba's choices on AI infrastructure, on instant delivery, they reflect broader trends that will likely impact many businesses and consumers. It's like they're building a skyscraper while also renovating the ground floor all at once.
That's a good way to put it, constant evolution.
So here's something to think about as we wrap up. Alibaba is making these huge bets on AI infrastructure and super fast e-commerce. What do you think the next big aha moment will be? The thing that really changes the game for consumers or businesses in the next year or so, driven by these kinds of investments? How will these bold bets ultimately pay off? And maybe just as importantly, what unexpected hurdles might pop up when you shift strategy so aggressively in such a fast-moving global market? Definitely something to ponder.